Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. My voice is a little bit bad today, so I hope it's not going to be too annoying. Today we have John Grady here to talk about scalping. John is from No BS Day Trading, and actually John was introduced to be excuse me, to BMT from Pete Davies at Jigsaw Trading. So I just want to quickly explain the way this works. So No BS Day Trading is not a BMT sponsor. And so as usual, that means that there is no hard selling, there's no secret sauce or anything like that in the webinar. It's only educational. However, if you are interested in any products or services sold by No BS Day Trading, then you can certainly contact them after the webinar. Jigsaw Trading is sponsoring this webinar. It's because of them that we're able to do the webinar. They helped to set it up. And normally, Pete would be here for the first 5 minutes of the webinar to give you a very quick overview of what they offer at Jigsaw. However, Pete had a bit of an emergency he had to deal with, so he's not here today. So I invite all of you guys to go check out his website, please, at jigsawtrading.com. I do want to remind everybody the webinar is being recorded. I'll post the recording on BMT later today. If you are watching the recording at a later date on YouTube and you like it, please do me a favor and give us a thumbs up. John has asked that we hold the questions until the end of the presentation. So what that means is that you can ask the question at any point, but I'm not going to interrupt John until he's through with the presentation, and then at that point we'll do an open Q&A and try to get some of the questions answered. Okay, so with that in mind, I'm going to turn things over to John, and I'll ask him to introduce himself, tell you a little bit about himself, and then we'll get started. All right, John, and I just gave you control, so you should be good to go. John, we can see, but I don't have sound. And what I'm seeing is like a Windows Media Player. Okay, hang on one second, guys.
How about now?
Okay, now we've got sound.
Can you hear me now, Mike?
Yeah, I can hear you.
Now it's coming through. Sorry about that. Sorry, I had something turned down. I had to turn up there. My bad. Okay, I'm glad you can see this then. Everybody can hear me. Thank you, Mike, for hosting this. I really appreciate it. New to the Big Mike forum. It's a really cool forum, though. I've been checking it out, so thanks a lot. And also a big thanks to Peter, who is not here today, unfortunately. Like Mike said, he would usually do a little intro and tell you a little bit about the Jigsaw software and whatnot, and then turn it over. But he put this presentation together for me, so thank you to him. And then thanks, of course, to everybody who's showed up to watch this. Like Mike said, I've asked that the questions be put off till the end, just so I don't get off topic too much. That happens really easily if I start answering questions mid-presentation. I can drift off forever and talk for 30 minutes about one question. So what I want to do today is shoot through all the topics that I have and hopefully get through them in a way that's you know, educational as well as somewhat entertaining. I try to keep it flowing so people don't zone out and, you know, drop out and get bored with what's going on. And then whenever I get through all the topics I want to discuss, we'll turn it over to some Q&A, and I'll be happy to answer any questions anybody has, all right? So with that in mind, a quick word about me if you're not familiar with who I am. Basically, I'm a trader. I trade for myself, and I've been at it for a very long time. And the reason that I think I eventually figured out what was going on was because I managed to land a couple jobs at proprietary trading firms. And one job in particular was in Chicago for a pretty large futures trading firm. And so what I tell people is, had I not had that experience, I most likely never would have really understood what was taking place. And this is kind of the core of where I want to go with the presentation today. Some people who are sitting here, you might, like the opening part of this, you might think it's a little bit basic, but it's going to progress past that. There are other people here that absolutely, some of the stuff I'm going to talk about, they are not familiar with at all. So I just want to put that right out there right away so you know. And then we're going to delve into some kind of real-world application after I get past the basic part. But I think it's very important to understand because a lot of people do not understand the basics of what order flow is, how the markets work in general, and the kind of games that are played on a daily basis. And so where I was going with that is that in my experience at the prop firm, it was there that I realized, I kind of figured out finally this is how the game is actually played. And the reason I'm mentioning that is because I came into it the same way most people did. I came into trading pretty much full-on technical analysis type of a person, which is the way most people come into trading. And I think, personally, the reason a lot of people struggle with this is precisely because they've never seen the business from the inside. They've never worked for a firm or a big brokerage or have never been on the floor of an exchange. And so they come in totally as a retail trader, and of course nationally most of the material out there that is focused on retail traders is based on charts and indicators and whatnot. And that stuff has its place at times. But what pretty much anybody inside the business will tell you, and by inside I mean who has worked for firms or who has worked for big brokerage houses and whatnot, they'll tell you that order flow plays a key role in most of their decisions, unless they're putting on trades that they're going to hold for months or years. But on a day-to-day basis, order flow plays a really huge role, and that's what I'm attempting to explain today. I want to pretty much get the point across as to why order flow is important, and hopefully the idea behind a presentation like this is that I can get people to look at the market a little bit differently than they are today. So whenever you leave here, you go away thinking about some things and saying to yourself, oh, you know what, that makes sense, and I hadn't looked at it that way before. And I'm going to explain why most people haven't looked at it that way. All right, so let's get started. What I want to cover today on my topics, and this is just a little topic list I put together for you guys. I want to start with the reasons most traders lose, or I should say the reasons why I feel most traders lose. We're going to progress on to what order flow is and why it's important, why I feel it's important. I'm going to share a few lessons that I learned while working for prop firms. I'm going to discuss how size influences the market and some misconceptions about pro trading versus retail trading. I'm going to discuss, I'm sorry, that's my thing. I'm going to discuss the importance of a good platform. And then we're going to go into the idea of scalping and what's called getting the edge. And these three things kind of go together. We're going to discuss scalping, reading the tape versus traditional technical analysis, and then HFT and some misconceptions about HFT. And then I'm going to finish off with some recorded price action and real-world application and context. Context meaning every scenario is different depending on how the day is played out up to that point. So you can't just have an if this then that methodology. Basically, you have to always be kind of adapting to what's happening in the moment. And so we're going to discuss all of that. So let's get started here. The real reasons why most traders lose, at least in my mind. The number one reason why I think most traders lose is because they don't understand the game at its very core level, right? What I mean by that is if you're sitting down to play any game, whatever it is, chess, checkers, poker, whatever, you have to know how the game is played, obviously, in order to have any chance of winning the game. And so what I was touching on earlier was the majority of traders come in from the retail side. And so they're looking at things that may not really have any influence on market direction. What do I mean by that? Well, I mean they're typically looking at, moving averages, stochastics, MACDs, maybe some pivot points, things of this nature, charts, obviously, and trying to make decisions based on this big conglomeration of all this stuff they're looking at. And what they miss kind of right off the bat is that everything that they're looking at, all those indicators, are all derived from this information right here. So every indicator that you see out there is based upon order flow, meaning the actual transactions that are taking place at the inside market and that are driving the market up or down. So what you're seeing right here on my screen, just so I can point this out briefly so you understand what you're looking at, this is Treasury futures, which is predominantly what I trade, but we're also going to look at the E-mini S&P a little bit later, and I'm going to demonstrate price action on both. But just so you understand where I'm going with this, this is my screen. I run 4 depth of markets at one time. It seems like a lot, but it's not once you get used to looking at them. And in a nutshell, what you're basically seeing here is just bids in the blue, offers in the red. This is your typical ladder, only it's jigsaw, so it's not typical. But in the middle, you're seeing prints. So basically, for example, what jigsaw does is it splits the uptick, downtick data. So for example, over here, this is the 10-year Treasury market. The most recent prints would have been 349 into 11.5 and 192 up into 12. And so now, right now, you have an inside market of 11.5 by 12. You have some buyers who are hitting 12, some sellers who are hitting 11.5. And that's what shows up in this blue and red, which is why I think Jigsaw is a dynamite platform. But we'll move on to that here in a few minutes. So I have the 10-year, the 30-year, the 5-year, and then the Ultra Bond. And that's not important to understand right now. It's just so you know what you're looking at. And then I have the day's volume profile. So this is the total accumulated profile for this session, this current day session, and then of course price. So the first thing that I want to point out is basically this, and I'm going to break this down, and I know it's going to sound really basic to some people, but just hang with me on this, all right, because this is important to everything else I'm going to discuss today. If you and I were the only people, or I say you and I, let's just say me and one other person, so I'm going to say you for now. So if you're the only guy on the offers, and I'm the only guy bidding, what do I mean by that? Right now what I mean is, you see, for example, over here on the right, 66 is bid at 20, and 137 is offer at 21. If I account for all 66 and you account for all 137, we're the only 2 guys in the market. In order for something to happen, one of us has to hit the other one. Because if I just sit here all day and you just sit there all day, absolutely nothing will take place, right? Okay, that's obvious. What has to happen is one of us has to hit the other one. So let's say that I'm the buyer and I start buying and I buy your 137 here and then I bid at 21. I bid 200, let's say. So now I take it up a notch to 21. Now you're the offer of 359 here at 22. And we sit there for a minute, and I hit all 359 at 22, and now I lift that, and now I bid another 300 at 22, right? And now you're the offer at 244. So it's just you and I in the market, totally for illustration purposes, but you'll get the point very quickly. Now you're 244 at 23. I buy your 244 at 23. I bid 300 at 23, right? Now you're starting to get a little worried because I'm not letting up. I'm continuing to press the market against you. So you offer 214 at 24. I buy 214 at 24. I bid 300 at 24. When it hits that point, you're starting to feel the pain from the P&L standpoint. And you try to slow me down now. So instead of just offering 214, you begin hitting me with 200, hit 200, hit 200. The problem is no matter how many you sell at 24, I just keep buying them, and then I buy 25, and then I buy 26, right? Now, obviously, most of the time, it's not just 2 guys playing the game, although sometimes it actually is just 2 guys at like 2 inside prices, but most of the time it's not. It's a conglomeration, obviously, of a lot of different people. The point here is that I'm driving the market against you by clearing out your limit offer orders, and I'm pressing it up. And ultimately, if it was just you and I trading, and I have more money than you have, I'm going to run that market up until you're forced to liquidate because you run out of money. And then when you're forced to liquidate, meaning you're forced to start buying, placing buy orders to get out, I'm going to be the guy selling to you way up top, and I'm going to take all of your money, and then you're going to be out of the game, right? So now I realize that sounds kind of basic to some people, and I hope most people are still with me on this. The reason it's important to understand that is because that's what's happening at the core fundamental basic level, you know. And so what I tell people is that you can't build an engine if you don't understand how combustion works. So in the same, you know, way, that's an analogy, you can't really build a methodology, a trading, at least a day trading methodology, if you don't understand how the game works at its most core fundamental level. And you know, unfortunately, a lot of material out there doesn't even really get that basic with it. And so what I encounter a lot when I'm talking to people is that they don't even really grasp the concept of a market going bid or going offer, for example. So by that I mean, you know, if I were to buy all 137 contracts here, and then I bid at 21 for another 200, the bid, you know, it's going to go up. That means I'm taking the market bid. I'm taking it bid again at 22, taking it bid again at 23. And so people sort of struggle somewhat with even understanding those concepts at times because they don't really understand what's happening. But what's happening is there's a wave there. And whether it be initiated by one guy or initiated by multiple guys, the whole goal is one side is trying to dominate the other side because they're trying to get the other side to puke out. And what do I mean by puke out is I mean exit. So you press the market against the losing side so far that they can't stand the pain anymore, and so they exit for a loss. And when they start exiting for a loss, that's exactly when the guys who have been pressing it are often liquidating for a profit, see? So for anybody who's heard the term stop run, and we're going to get into this in a few minutes, someone has the idea of what a stop run is. So let's say, for example, you have the market down here, and these are the lows of the day over here in the 10-year at 9.5 and 9. And sellers begin winning this battle, and they get the market down here. Well, the idea, of course, is that sellers want to press the market through the lows of the day because they want anybody who's long all the way down. People who are long pretty much from this whole thick area, say 13 all the way down to 9.5, they want those guys to give up and get out and start selling to exit for a loss. And when they start exiting for a loss, the guys who are pressing it through are working buy orders to cover for a profit. So is that 100% of what's happening? Not always. You know, I mean, there are some players who actually do take delivery of contracts. There are guys who take delivery of treasury bonds, cash treasury bonds. In the grain markets, there are obviously people who take delivery of corn, soybeans, wheat, right? I mean, they're out there. So you have producers and consumers who do take delivery and offer out contracts. You know, you have a corn grower who ends up selling his corn to a cereal manufacturer, and those guys end up buying and selling it and hedging themselves. But the majority of volume that you see taking place on a daily basis is outright speculation. I mean, it's just guys coming in, buying, selling all day long in an attempt to extract money from other players, and that's really all it is at its core level. And so that's point number one, basically. If there's anything else I can convey to you today, that's like point number one. The major point is understand that for the most part, this is usually an elaborate poker game. And there are times when the heavy buying or selling win the game, you know, and they press it far enough that they cause the other side to give up, and then the other side gives up, they get out, the guys who are pressing it get out, and then the market just dies. And that's why you see a market will run 10, 20 ticks, 30 ticks, and then it battles it out, and it kind of pulls back in and retraces maybe 10, 25%, whatever, 40%, and then all of a sudden the market just goes flatline, right? So and a lot of people get confused, and they're like, I don't understand what happened there. I don't understand how the market could break from 12 all the way down to 5, come back to 12, and then flatline. Well, what happens is one side wins, one side loses, market comes back in, and then nobody wants to play anymore. And so when no one wants to play anymore, nothing happens and there's nothing to be done. And that goes into context, which is, like I said, something we're going to discuss a little bit later. So moving on. That pretty much describes what order flow is. So, order flow is basically just the orders coming into and out of the market. You have sellers offering, buyers bidding. Eventually they match up, on the inside market, and then one way or the other somebody gives up. So, for example, right there, if I was buying 137, you don't want to sell anymore at 21, you're not going to offer out anymore. There won't be an offer there. So I have to now bid at 21 in order to get any more contracts off. So that's what order flow is. Why is watching order flow important? Watching order flow is extremely important because it lets you know how much size is trading at certain prices. And it can give you an indication of areas that, might be just back and forth chop. For example, over here on this particular day, what you see on the profile is you see 87,000, 82,000, 89,000, 88,000, right? So the market was basically in a 4-tick range there with a little bit going outside it. But for the most part, you had a dead market that was trading a lot of volume in this area. And that volume lets you know what, this is just kind of a choppy nothingness area. There's really no reason to be involved there. Whereas, in a different scenario, in a different context, for example, maybe if they actually get up here to 15, 15.5, if they break kind of through where you see it's 58, 36, and now it's only 5, 5, and 6, that may trigger some more buying, that runs through that level right there. And it might stimulate some action. And so the order flow that sort of takes place and the way that orders are being transacted, getting to that point and getting through that point, if they do, can sometimes tip you off to what may be the next movement, at least, the next movement for a few ticks. So on that note, let me progress on to the idea of scalping kind of at its core level. The idea of scalping in general, unless you're dealing with HFTs that are really just trying to arbitrage prices, is not necessarily just to work for one-tick winners. And that's a misconception a lot of people have about scalping. So a lot of people think that scalpers are guys, I'm trying to buy 11.5s and work 12s. Not really the case most of the time. Sometimes you might be in a situation like that where the market's really slow, and that's a potential methodology to have at that point in time. But usually scalpers are looking more for the next maybe 3 to 5, maybe beyond that, it depends. But the idea is not that you're just going for 1 tick or just going for 2 ticks. The idea is that you're trying to get involved in areas where it seems like the pressure, statistically speaking, is in your favor. And that's what I'm going to discuss here in a little bit on this video as I progress through it. So the idea is not buy 11.5s, work 12s. The idea would be more kind of watching the order flow in a sense of what I mentioned earlier, which is I'm watching to see, does it look like maybe buyers are going to lift the offers and run through 14.5 into this area, or does it look like sellers may be pressing the market down in an attempt to run the lows? And I don't need to see anything else to get a feel for that. I mean, and this is, again, I'm kind of a hardcore scalper, so I predominantly only watch the order flow. And I'm not saying that you can't use technical analysis to help pick possible points, of action, points of exiting, points of entry. I'm just saying that if you're watching the depth of market and you're watching the ladders, what you really need to see is right there in front of you, because anything that you're seeing on the chart or on the averages or whatnot, they're being pulled off of this. And so you kind of have to live in the moment, and to live in the moment to its pinnacle, so to speak, you would be watching the orders as they're executed right here, right now on the ladder, okay? And this is what tends to give you sometimes information as to what's happening. Other times it doesn't, and in those times I tend to step aside. But that's kind of the point, behind being a scalper. So the question is, where do I come up with my methodology? How do I know that what I'm saying is accurate? And that goes to what I was saying earlier, which is working for a prop firm, okay? So when I was working for a prop firm, I was working for a futures firm. Just a quick rundown on this. Basically, they had several groups. They would bring in a group of anywhere from 5 to 8 guys at a clip. They would teach you for just a couple weeks on the platform that you were using, and then turn you loose with a one lot and basically say, figure it out, right? There's not as much training in prop firms as people seem to think there is. Quite frequently, a lot of them show you the basics, which is what I'm showing you right here, and then they give a person a one lot and say, figure it out. The difference is that they don't have you looking at the charts and indicators. What they do is they sit you down in front of a screen and they show you this. They show you the ladders, and they say, stare at this and figure it out. And that's not just my experience. That's the experience of pretty much every professional prop guy that I've ever met. And even as a quick example of that, this is not, this is just for illustration purposes. I wanted to bring up a couple of pictures here just so you guys could see it real fast. So this is a picture of a prop room. And if you take a look, and you can just Google this on your own, like just Google proprietary trading room floor, and you'll start to come across pictures like this. But you look at this guy's screen, he's got ladders, ladders, ladders. You look at this guy's screen, he has ladders. You look at this guy's screen, ladders. This guy's screen, ladders. This guy's screen, ladders. These guys over here, these are all ladders up and down. And every picture you look at is like that. Like I pick up, this is just some guy, I don't know who he is. Again, just a picture. On his right screen, he has 7 ladders. On his left, he has 6 ladders. And the guy has 13 different ladders up that he's looking at. Very, very common. This is the floor of an exchange. If you look behind them, they have ladders in the background, right? They have the depth of market running in the background. Well, that's because the guys on the floor want to see what's going on the orders on screen, right? And of course, floor trading is kind of dying off. More and more volume has been flowing into the electronic markets over the last 5, 6, 7 years. But they're there. And the reason I wanted to show those images real fast is because I want to illustrate, this isn't just my opinion. It's when you get within those realms, you begin to see everybody is staring at the ladder. All the traders in the room are staring at the ladder. All the guys on the floor are watching other guys on the floor and staring at the ladder. And it's not that guys don't have ideas about moving averages or pivot points or whatnot. They do. But, a lot of them are making their fundamental plays based on the order flow. And HFTs in particular, and we're going to touch on this in a second also, are almost 100% order flow oriented. I mean, because what they're looking for are places where they can get in with no risk. So they're looking for a big order hitting the market, and they're trying to front run that order and then scalp it out as fast as they can with no risk. And they do that all day long. And typically that's on smaller size, sometimes on larger size. But so that's the idea, right? And so it was while I was at the firm that this became clear to me. Well, how did it become clear to me? Well, how it became clear to me was I was sitting behind a guy. I was like group number 3. And a guy from the very first group finally turned the corner and started printing like real money, big money. And he got to the point where at that juncture in time, he was trading 200, 300 contracts at a clip in the 30-year. And this was during a time period where that actually could move the market because the 30-year would only be 100 by maybe 150 on average. So, for example, over here, you see 66 by 137 in the Ultra Bond. The 30-year used to look just like this, basically. So an offer or a bid of 400 or 500 contracts was a very large offer or bid. That's changed somewhat. So the premise hasn't changed, but the amount of volume has changed since then. Anyway, the point is this. I began watching, because I could actually see this guy's screen from behind him, and I began watching what he was doing, and what I realized was that his orders would actually move the markets at times. And so all he was doing, and he didn't look at charts at all. I mean, all he had was his depth of market up, and this guy would do thousands of round turns a day. He actually overtraded, and he would tell you that he overtraded, but he was in and out all day long. What I realized was that he was moving the market, and at times, I mean, you can get run over too, even if you're trading size, but guys can move the market like that, and then they trigger other guys to move the market, and then other guys move the market. And the whole idea behind the trading is that a wave happens, and you're trying to ride that wave. But where people kind of miss the boat, when they don't understand, is that the wave is generally created by heavy hitters. It's not that a string of stop orders can't move the market. It can. But this is what I tell people. You know, and this is a big misconception, going real quick to a topic here, misconceptions about pro versus retail. There's kind of a misconception that professional traders are always trying to take retail money. And that's true to an extent, but here's what you need to keep in mind when you're contemplating that. A guy who moves 4,000 contracts isn't looking to trade 4,000 contracts in the 4,001 lot traders, okay, or 2,000, you know, 2-lot traders. I mean, obviously, if they're there, he'll take it or whatever. But in general, this is a battle between heavy hitters. It's a battle between guys that swing a few hundred, or maybe like in the 10-year, a few thousand. And so if a guy is piling on board and he's hitting it with 1,000, hitting it with 1,200, hitting it with 1,600, his intention isn't that he's going to get short 4,000 contracts, and then there are going to be, like I said, 4,001 lot traders out there that he's going to take their money, because he knows that's probably not going to happen, because there aren't going to be 4,000 guys trading the 10-year. He's battling it out against other guys who are trading 1,000, 1,500, or other guys who are trading 100, 200, you know. And so you have pretty much a battle between guys that move decent size all day long. And then, yeah, you have some retail traders out there who are trading 1, 5, 10, 20. And they're, you know, maybe scalping a few themselves or losing a few themselves, getting chopped up in the process. But it's literally kind of like a swimming pool where sharks are after sharks. And yeah, the minnows sometimes get eaten and sometimes they escape, but they don't really account for the major part of the battle. Now, when a major move takes place, yeah, then you can have a bunch of small, like 50 lots, 10 lots, 20 lots hitting the market all at the same time, and that will jam the market real fast in one direction. But the move is typically initiated by size, and so this is where I talk about size influence in the market, and that's where I first figured it out. All right, and so at my peak, and I was trading for a firm, so they had a lot of capital, but I mean, at my peak, I was trading a few hundred contracts at a clip, and I knew guys that were trading as big as 2,000 in the 10-year. And I actually knew a guy who worked for Refco before it went under, who traded big in the 5-year. He was like a 2,000 clip trader in the 5-year. So that's, you know, I'm only sharing that because that's where I got my inside look into what I'm telling you today. And if I had not seen that, I would probably not be sitting here talking to you today. You know, I most likely would have never made it as a trader, because you can't understand that unless you see it. So the next topic that brings me to is the importance of a good platform. So today, retail traders are starting to see what they've been missing, because they now have access to better platforms at reasonable rates, right? And Jigsaw is one of those. I'm obviously a big advocate for Jigsaw and highly recommend it. I don't think Big Mike minds, since, you know, Peter, like you said, he put this together and whatnot. Jigsaw is an awesome platform. I use it 100%. It's the only DOM that I use, or DOM, however you want to pronounce it. But this is the reason a lot of retail traders struggle also, and a reason why a lot of people fail, and did fail in the past. Prior to me walking into that proprietary firm, I had never seen a ladder. I had only seen, this tells you how far back we're going, you know, I had only seen inside market order placement. So, you know, you click the little box pops up, you place your order over here, and then it asks you if you want to confirm, and then you see an inside market. And that's all you see. There's zero depth whatsoever. And forget about accurate print information. So the idea of knowing that 87,324 traded at 11.5 wasn't even available. Couldn't even get that information. So when you have guys out there who are trying to understand what's going down and what's actually happening, and the reason they're looking at a lot of other stuff is because they don't have a very good depth of market most of the time. And so, or maybe they pull up one that's not one of the greatest platforms, that maybe only has a few levels of depth, or it's not really conducive to showing the prints accumulating really well. So instead of it showing 192 here, there's a quick blip, and all you see is maybe 5. And then the market goes up. So you think the market went up on a 5-lot trading when in fact the market went up on 192 trading, right? So for years and years, no one had access to any kind of a decent ladder. And so whenever I went to the firm, what I grew up on was X-Trader. They had TT's X-Trader in the office. And every pro office in the world practically still has X-Trader, or they had X-Trader, or now they've developed their own front-end platform. And a lot of those were very expensive. So even if you were a retail guy and you knew about X-Trader, it was going to cost you $1,200, $1,500 a month just to have access to it, which is a huge nut to cover for most guys who are out there. They can't. If you're trading a 4-lot, you can't afford to trade. Have X-Trader. I mean, it just doesn't make any sense. So people didn't have access to that. Now, thanks to Peter and guys like him, you have a platform that shows you everything X-Trader shows you. In my opinion, it shows it to you better because it splits the prints. And so now your average retail guy, for a very, very modest fee, almost ridiculously low, and that's not a sales pitch, it's just accurate, because X-Trader, the basic now, costs $500 because they've had to come down. That's the whole point. X-Trader and CQG and platforms like that have had to reduce their prices over the last few years because there's too much competition now. They can't afford to hit people with $1,200, $1,500 a month for just a basic ladder. So their prices are coming down precisely because there's competition out there like this. So this platform now shows you things that you never would have seen before on a subpar depth of market platform. All right, so when people begin to watch a platform like this, all of a sudden a lot of what I'm talking about makes way more sense. And so that's the first thing that I always tell people is if you don't understand why order flow is important, you need to go get a good depth of market and just stare at it for about a month. And don't stare at anything else, because you'll begin to understand why order flow is important. Usually people don't understand it because, like I said, they don't see it. They don't see the real order flow. They're only seeing a fraction of it, so it doesn't make any sense whatsoever. Once you begin to see it, you start to see the importance of having one. Moving on. So moving on, I'm going to group these three kind of into one topic, which is the idea of getting the edge. I'll explain that. Scalping versus like swing trading styles, reading the tape versus technical analysis, and then HFT. Okay. Getting the edge. What does that mean? It's a common term that is used in trading firms, much like the term puke out is used. What getting the edge means is this. In the most ideal scenario, and this doesn't happen all the time by any means, but in the most ideal scenario, if you thought the market was going to go up, we'll just stay on the left-hand side over here in the 10-year. If you think the market's going to go up, you would see the 2094 starting to print, and as it was printing, and I'll show you this in the video as we progress, you would buy it. The market would go bid at 12, and instantly orders would start hitting 12.5. In other words, buyers would start buying 12.5. There would be a big bid behind you at 12, and you would instantly be sitting in a break-even trade right away. You buy 12s, 12s go bid, someone's buying 12.5s, and you're sitting in a break-even trade immediately. Someone buys 12.5, now the market goes one tick in your favor. You're sitting in a one-tick winner, and you have a free look at seeing what happens, because if you choose to do this, okay, this is all obviously about trade management, but if you choose, the trade at worst will be a break-even trade because you have the edge. That's what the edge means. The edge means getting into a trade that moves in your favor so that worst-case scenario, it's a break-even or maybe like a one-tick profit. And like I said earlier, it's not always that you're just playing for ticks, or in the sense that you're not holding necessarily through some chop sometimes. Obviously, as a scalper, you're going to find yourself in situations where you have to read it out a little bit better, or hopefully read it out a little bit better, assuming you make the right call, and hold through some chop. That's definitely going to happen. But ideally, the perfect scenario is you hit the market goes bid in your favor, you immediately have the edge, right? And you immediately have the free look. Where reading the tape comes into play, so going to the reading the tape versus technical analysis comes into play, is that if you're just looking at a chart, right, and let me bring up a couple of charts that we can scan out here. I'm going to show you guys. So if you're just looking at a chart, for instance, you're trying to get in at a good price, you see this chart start to click down, but you're not seeing how it's trading down, right? So if you're watching the order flow, you can actually see, okay, there's 2,000 on the offer, and then you watch 1,800 trade into that 2,000. Well, now you know buyers are actually buying 12. So you can see guys are actually hitting 12 on the depth of market. So if you're contemplating a buy order, you know, rather than just randomly placing a buy limit at 11.5 or 11, or a buy stop at 12.5 or something like that, you can pinpoint entries and exits better, because you can actually see right here, right now, at this juncture in time, someone is buying 12. Now, will they continue to buy 12? So that goes into context and some other stuff I'm going to discuss here in a few minutes. But the point is, you see it happening right now. You know there are buyers at 12. So if you're going to hit it, you might as well hit it when other buyers are coming behind you, you know, because you know you have it there. And the whole idea, of course, is I'm trying to get the edge and hope that it goes up. Whereas with your traditional technical analysis, what usually happens is you have kind of orders working in areas, and guys are often not paying attention to the order flow and how the prints are affecting the inside market. And quite frequently, even just from a pure execution standpoint, you can save ticks by paying attention to this. You know, there's plenty of times when you might want to be long, and you're thinking about hitting 12s, but then you realize, well, actually, no one's really hitting 12s just yet. I can probably get filled at 11.5 because there's not that many on the bid. And you save yourself that tick by not just randomly hitting out there and buying 12, or hitting out there and selling 11.5. So all that can be seen here on the inside market. And that's another advantage to, again, what this whole presentation is about, reading the depth of market versus traditional technical analysis. From an HFT standpoint, right? An HFT standpoint is a very same thing. If an HFT program, or a trader who's just a high-frequency trader, a lot of people don't understand that either. It's not always a program. Sometimes it's just a guy. But you know, have a program that's planning on buying. The program's not just going to step up and buy because 192 contracts prints into 2,000. Not going to happen. The program's going to wait until it sees more size trade into that. So the program's doing the same thing. It's waiting to see whatever, 1,000, 1,200, 1,300 print into that 2,000, and then the program executes, because the program is trying to get the edge. It's trying to get risk-free money. It's trying to do what traders have done for years. Going to that same situation, for example, going back to my image on the exchange floor, I want to just show this, and I realize the floors are dying, but this gets the point across. So if you have any misconceptions, what would happen in the floor would be guys would actually fight for position on the floor. And the reason they would fight for the position on the floor is because they would figure out eventually who the big traders were, like individual traders for themselves, and they would also figure out who was a broker for big institutions. So for example, what would happen would be, let's say this guy doesn't have his hands up in the air right here. He's looking to the right or looking to his left. Total theoretical thing, but this is how it actually went down, because I've talked to many guys who are on the floor. He could be watching, and he could see a guy coming into the pit who he knows was a broker for Goldman Sachs. And he can tell by the way that guy's about to move his hands, the guy's about to offer out. So what he does is he turns to the first bid that's near him and he hits it. So let's say this guy over here is bidding at 10, and he hits his bid for 10, and then he turns around and waits to see if he's right, and the Goldman Sachs broker lifts his arm. The broker lifts his arm, he starts offering. He offers at 11, he offers at 10, he offers at 9, he offers at 8, and he's moving the market because he's moving 1,000, 2,000 at a clip. He offers down to 8. This guy is short 100, 200. He turns around. He buys back his 100 lot, 3 ticks lower. It's almost guaranteed money for him because he was able to read what that guy was doing who was coming into the pit to work an order for a brokerage. So hopefully that makes sense. If it doesn't, you can rewatch it on the recording. But that's the idea. So that's what floor traders used to do. That's what scalpers do now. It's what HFT programs do now. They're going for the risk-free money. Why is this important to you? It's important because they're influencing the market on a moment-to-moment basis. And that's why you see things like this. Okay, we're going back just a couple of days. This was Monday, I believe. This is a chart of the E-mini S&P, right? It's a 10-minute chart. What you see on this chart is you see the market opens up right around here, or goes live for the cash open. Breaks down. This was actually near the overnight low. Stops at the overnight low, rallies all the way back through the open, breaks the overnight high, which was right here, okay? Goes through there a little bit, chops around for 20 minutes up there, starts to pull back in, comes back towards the overnight low, chops around, breaks, chops around, breaks heavy, bottoms out, rallies all the way back up in the afternoon, and finishes the day basically right where it started, okay? This is a really critical point, if I can get across to you also today. The idea that you can predict the future like an hour or two out is usually not accurate, at least in my opinion. This is all my opinion, but take it for what you will. To be sitting there and you're short in this area and you think the market's going to break all the way down to 1846 later in the day, I just don't see how that's realistic because so much influences the market. And this is my point. On a dime, the market can change around. When the market starts to change, it changes because size moves it one way or the other. So when players who are trading 100, 200, 500, 2,000 start driving the market up, they bring in other money. The other money starts jumping on board also, 50s, 20s, 10s, 50s. They drive it up. And then eventually they run into a wall. The wall is by size. Somebody else comes in that's trading 3, 4, 5,000 contracts. They stop the market. Market starts moving back down. Market's moving back down because the guys who are buying here are now trying to cover and take a profit. Market starts moving down more, starts breaking. Other guys jump on board, drive it down lower. Eventually, the guys who are short from here and here and here and here decide to start covering their trades. When they start covering their trades, the guys who are shorting here start covering their trades. And then new buyers come in, and they drive the market back up. And so you have this whole elaborate thing that plays out over the course of the day, and it's not driven by anything fundamental, if you understand what I'm saying. So as an example, an analogy, if you go to a farmer's market, in other words, like a farmer's market where they actually have apples and oranges and strawberries, right? What traders are essentially trying to do, HFTs in particular, are they're trying to find a guy who's willing to buy an apple for $1 and another guy who's willing to sell an apple for 99 cents. And then they go and they buy the apple for 99 cents and they turn around and they run across the farmer's market and they sell it to the guy who's willing to pay $1 for it, right? And they scalp out a penny on that transaction. And all day long, guys are attempting to do that. They're scalping out whatever, ticks left and right. And losing ticks left and right too, but that's the whole point. So if nothing fundamental is really driving that, with the exception, and I don't mean nothing fundamental drives the market over time. I mean there are generally fundamental reasons why the price of corn goes through the roof. I mean if corn goes from $2 a bushel to $7 a bushel, it's probably because the Chinese are buying en masse, over time. So that there's obviously a fundamental drive from that perspective. And sometimes there are fundamentals driving it one way if there's a really critical news event or non-farm payrolls misses in a huge way. Like they estimate it to be 50,000 and it comes out 150,000. Obviously, you have some fundamentals at play there, But even then, most of it's speculative. So anybody who's trying to make a play on that fundamental information is going to cover and be flat at the end of the day. So when they start to cover, that's going to move the market. So to have the idea that you can go in the morning and buy the open and sell the close and accurately predict where the close is going to be, a day like this should kind of put you off of that idea, because it's a really good illustration of how easily the market can turn around and go back and forth and back and forth. And I don't really care who you are. It's like if you're long at 1864 and the market's trading 1848, you can't know the market's going to come from 1848 back to 64 by the time the day is over. I mean, I have no way of believing that most people can tell me that, unless they're the guy who can support it and move it up there. So a similar thing, I was just going to show a 10-year chart. Same thing happens. 10-year drops off one day, bottoms out, goes all the way back to the highs of the day, tops out, comes all the way back down to the bottom. Similar type situation right there, right? So, and what I wanted to do real quick to just farther elaborate upon that, and then we're going to move into this video and get into the Q&A. I had some notes here. Let me move past this. Technical analysis versus reading the tape. So I just wanted to jot this up, like for people that they like to see things in writing. Maybe you want to make a note of this, review it later on down the road. This sums it up, and I wanted to write it down so I wouldn't forget. Basically, charts only show you the price, okay? They don't show you how the market traded at that price. That goes back to what I was saying with regards to a chart can't show you that this price was taken out by 200 or 2,000, and it makes a difference how the price is taken out. I'm going to illustrate that in a minute. Does the market bounce at a certain price because it was light volume after a number release and people are flying by the seat of their pants trying to trade a highly volatile response? In other words, did the market put in a support level because non-farm payrolls came out and market spiked down on really light volume, and then all of a sudden a bunch of people started playing and then they drove it back up? Or, was a support level established because the market steadily trended down and then it bounced because a huge amount of money came in to defend a certain price and then an attempt to press it back the other way? It makes a big difference if you're looking to trade in that area. That's my point. If you're looking at a support level from earlier in the day or earlier in the week or earlier in the month, it makes a difference how it traded at that support level, because it could have been established in a few ways. And so here's the point, the big point. Charts only show the past. Everyone in the world is looking at the same obvious support, resistance, moving averages, and pivots, right? So anybody can bring up a chart and they can draw the trend line. They know where the support and resistance is. Pivots are usually near by one another. I mean, different people calculate pivots in a different way, but they're usually pretty close to where they are. The main thing to remember is just because someone is watching a price doesn't mean he is willing to trade that price, right? A support level is not a support level unless there are enough buy orders to overwhelm sell orders and prevent it from moving lower, right? So you can say all you want that 9.5 is a support level, but it's only a support level if enough buyers are able to beat out the sellers if the market gets there. Hence the reason you want to be watching the order flow. You can even see the last time it was down there, 6,000 traded at 9.5, and that's what stopped the market there. The market couldn't get below that 6,000. Finally, the sellers gave up. Market rallies back up. Sorry, I keep popping up in the wrong thing there. So, for example, during a particular day, traders on one side may go for a price where they believe there will be stops, and the stops are there so they get paid. What do I mean by that? I mean, same thing. On a particular day, sellers might try to run the low, and they're going to go for stop orders. If stop orders are there, in other words, sell stop orders are there below the low of the day, these guys are going to get paid. The market will break. They'll get paid on the short trades. On a different day, the stops may not be there, and they don't get paid. Either way, they react to what happens as the market hits those prices. If the stops are not there, the traders making the run do not sit and wait hoping they're going to be there later. They begin exiting in an attempt to not get stuck on the wrong side. So what I mean by that is if sellers try to trigger off stops below the low of the day and they realize they're not there, so in other words, no one's stopping out, orders are not slamming the next prices, they don't just sit there all day long hoping the market's going to run lows. You know, they start working out of their trades for either a small win, a small loss, or a scratch, because they're reacting to the moment. And you know, that's something that people also have to realize. Everybody is flying by the seat of their pants. They just are. I mean, in lower volatile periods, guys have positions and they may work out a net position in some way or another, but they're always adapting based on how the orders are moving. And to read up on that, if anybody is interested, you should read up on a guy called the Flipper. His name is Paul Rotter. Actually, I'll just type his name in here for you guys. He's a huge, massive trader. There are other guys like him, you know, big-time traders, and they basically explain the same thing, which is they're working orders on the bids and offers all day long, trying to feel out what's taking place. And they're not shooting for huge leaps, you know, in the market. So how does all this come into play in real-world application? Excuse me, one second. What I did here was I set my recorder on a few days hoping that I would catch some action that could be used as a decent illustration. And I had it running while I wasn't in front of my screen, so I'm going to show you a few different moves in the Treasuries and then in the S&P, and just kind of explain real quickly the idea of context to sort of top it off right here. One more thing let me discuss before I get to that just real quick. A lot of people, when you talk about scalping, they instantly discount it because they've heard all the rage about high-frequency trading, right? And they think, well, because of HFTs and programs, guys who are trying to scalp for a few ticks or a tick or whatever have lost any edge that there is to be had, and it can't be done. First off, that's inaccurate, but something I want to point out with regards to stocks and futures, most of what you hear about in HFT, most being probably 90%, takes place in equities. So when you hear about HFTs scalping stuff out to bring up a level 2 platform, it's because you have multiple exchanges. So you can see here you have a couple of, 2 exchanges. This is a level 2 screen, just a screenshot. You have 2 exchanges bidding at 49, one at 46, one at 44. But like over here, you have 4 different exchanges offering at 55, 2 offering at 51. HFTs are working orders across multiple exchanges, again, with that Apple analogy of buying at 99 and simultaneously selling at $1. So the idea would be they can buy at 51 on one exchange because they can instantly sell at 52 on a different exchange. Or they're also paying for order flow through brokerages or matching up orders in-house. And most of that is in the realm of stocks. There is some in the realm of futures, but the reason that they can't pull off what they pull off in stocks is because most futures contracts are locked to a single exchange. So for example, these treasury markets here are on the Chicago Board of Trade. 99.9% of the volume in treasury futures is executed through the CBOT. There are some other exchanges that offer contracts, but the liquidity is almost non-existent. There's hardly anybody there trading them. So you do have HFTs trying to do what I was describing earlier, which is hit prices as they go, trying to get that edge, and they will beat you to the punch. An HFT, if it's going for it, it's going to beat you before you click your mouse, which is why you have to anticipate pretty well these days. But it's less of a detriment, I believe, in the futures markets. So it's just an example, one other example of why futures kind of beat stocks in the realm of trading, in my opinion. So don't be too put off by that or think that HFTs are dominating the markets to the point that you can't make any money. They're out there, they have an effect, they are very fast, but you should really read it. Like, it's outside of the scope of this presentation to really cover it in depth, but I recommend that people read up on what's really taking place in the HFT world, so you get a feel for how they actually influence the market. Because typically what you don't have is you don't have an HFT is not trying to scalp out on 3,000 contracts. They're trying to scalp out on 20, 50, 100 contracts, maybe in the 10-year. So you're still always looking for size. Okay. So to just top off the presentation and move into the Q&A, the last thing I want to show you here is some video footage. It's only 5 minutes, and discuss, is it possible to predict the future with any consistency? Do higher probability trades really exist? Is it all just a coin flip? And context. Context meaning paying attention to the current scenario that you're looking at. So I'm obviously not going to sit here and say you can beat the market, because I don't do that. Some people are going to win, some people are going to lose. There are obviously no suggestions to buy or sell. It's educational purposes. But if you're looking to develop a methodology and to try and attempt to gain consistency by watching the order flow and thinking about context, this is what I want to just kind of show you today. So what we have here, like I said, the Treasury markets, this is kind of middle of the day. I think this was around noon. What you're going to see, just for a few seconds, is that nothing's happening. So, for example, over here, the 349 have traded down, 192 have traded up. We're sitting here. The bids and the offers are changing a little bit, but nothing's happening. There finally you see, a 4 printed into 12. But basically, it's a dead flatline market. And what this goes to, and the point that I was making earlier, is that, yeah, I mean, if you're a trader operating under the assumption that you can look at bars on a chart, for example, or you're kind of going from a daily viewpoint, thinking you're going to buy on Monday, sell on Wednesday. And I'm not saying it's not possible. I'm just saying, most of the pros that I know read order flow. So it's not a knock against swing traders. It's just my viewpoint and why I think swing traders could even benefit from learning to look at the order flow. If nothing's happening, nothing's happening. I mean, I don't see how you can be sitting here in a market and it trades 4 contracts over the course of 40 seconds and think that you can know the market's going to go from 11.5 to 16, or the market's going to go from 11.5 to 7. I just don't see, why you would think it's possible to know that you have an advantage one way or the other. At least whenever I'm looking at it, I should say, I don't really see any edge there. I don't see a reason to fire into that. This goes to context. This is moving on to the S&P. Same thing. I have the E-mini S&P on the left, the NASDAQ in the middle, and the Dow on the right. Again, it's kind of middle of the day. This is called the reconstructed tape. By the way, if you have questions about Jigsaw, I'll be happy to answer what I can. I would recommend, like, specifics you direct towards Peter. Send them the emails or hit him up. They have a chat room and whatnot. And he'll be much more knowledgeable and able to help you on, like, software specifics and whatnot. But I can answer basics in terms of what's happening. But anyway, to watch the S&P here, what you'll see is kind of a similar thing. You're going to see the market break down a little bit, a couple ticks, but then not much happens. So even right here, I mean, you can see it's just kind of trading inside, couple back and forth at 50, 75. So right there, they sell 500, take it to 50, right? Goes offer at 50. The NASDAQ comes off a little bit. They print a few into 25. There they go. They sell 164 into 25s, take it offer at 25. A few, 14 trade down into 70 even. And then the market just kind of flutters around. And where I'm going with this is you're going to see the comparison here in a minute. They're right there. It pops back on 25. They trade 300 back up into 25. And it just sort of sits here. Not a lot really happens. And so there's no defined pressure. And it's not saying, I mean, sometimes there are areas where you don't see a real defined pressure, but it might be coming up on a pressure point. But if it's 11:30, noon, 12:30, 1 o'clock maybe, some people are at lunch, some people have gone home, you know, the context is very different. And there's where you kind of see, like, it breaks from 75 to 25. They only print a few into even, and now it's kind of trading 25s back and forth, and nothing's really happening. All right? And again, looking at a chart, you have no idea. All you see is a price moves from 75 to 25, and now it's kind of hovering there. But if you're watching the depth of market, you can see, okay, we have a little bit of nothing happening, basically, right? So now what we're going to do is we're going to contrast that with a completely different scenario. This is, sometimes I run the ES up next to my treasury platforms. So for this example, don't pay attention to the treasuries. I have them up here. I was just recording this, and I managed to catch this as I was away from my computer. Totally different scenario. You have an S&P that's been selling off kind of all day long. It's approaching the lows again here at 72.25 and 72.50, 75. And you're going to have sellers actively hitting into these prices. So it's not, you know, that any given time you're going to sell breakouts or buy breakouts or whatever, but just from a context perspective, you know, if the market's trending down and you see sellers actively hitting into buy orders, and they seem to be overwhelming them, it's probably not the best idea to step up and place a buy order in front of that. It just doesn't make a lot of sense. And it doesn't matter whether 72 is a support place on, you know, a chart or a moving average or a trend line. It just doesn't matter. The reason it doesn't matter is because if you've got guys that are long right here, here's something to understand. A guy is long from 75 to 73.50, let's say. So 72.75, 73.50, somewhere in here. And maybe he thinks the market's going to bounce back eventually, but he realizes that it's not bouncing back right now. He's not going to hold that trade from 75 all the way down to 65 even, or 66, you know, like out of sight, which you can see on the screen right here. If he thinks the market's going to break lows again, he's going to bail and dump his trade, maybe even go the other way and reverse, and then try and buy back at a lower price. So from a context viewpoint, when you see a market snapping lows on volume, which is what we're going to see right here, if you can see this. So there you see them take out 50s. They're going to trade a little bit here at 25. You see them hitting 25s right there. You can see it stacking up. Another advantage of Jigsaw is you can see refreshing orders. So 700 have traded down. Now they take out that price, take out the next, take out the next, kind of bounce a little bit right there at 72 for a minute. Snap through 75s and then hit 71.50s, 71.25s, right? So what you're seeing here is a snap through lows. So we're looking, they sit on 50s, they sit on 25s, they sit on evens, and they create this snap effect. So this is like I was talking about earlier. It's one of those time periods where you have stop orders obviously being set off, and the stop orders are driving the market lower. Is it a guarantee? No, it's not a guarantee. You know, there's always a luck factor, and I'm going to talk about that to finish off here in a minute. But you know, there's no point in standing in the face of that kind of pressure. It just doesn't make any sense. And so, yeah, a chart might be showing you that the market's going down, but it's just an illustration of the ways that you use context in terms of how is the market behaving, what's taking place right here, you know, what kind of size am I seeing trade at each price, et cetera, et cetera. So this market ended up trading down into this area. They snapped through lows, and then they hit kind of a point here where the market bounces around for a while. And I didn't want to just let it add up for the whole time because it took a few minutes for this to play out. But what you eventually see is they trade a lot of size right in this area, and then there's another wave down that follows it up. I'm going to let it get to that point, and then I'll pause the video for you real fast. And you can see right here, notice how easily it snaps through these levels, right? So you have 9,000, 8,000 here, 4,000 here, and then it snaps through. Only 819 trade at 75. So it snapped through these levels very easily, and then it hit some size a little underneath that, but you still have sellers banging into the bids. And I'm still here. I'm letting it go real fast. There's a point where I jump forward just so you can see it continued on. And you'll notice, like right here, 5,000 have traded, 3,000 have traded there at 71 and 70, 75. Now it's added up a little bit more. Now you see like 11,000 have traded between those two prices. And then right there, I fast forwarded ahead a little bit. So you see it traded a lot of size right in there, and then eventually snapped through again to the downside. And we're just talking about context here. So same thing in the treasuries. Moving on to a treasury example. And it just so happens it was lows also. This wasn't really set up. I just happened to catch this recording, like I said, on over the course of 2 or 3 days I was running my recorder. But similar thing, you have a market that's breaking lows. You're going to see sellers pounding into it, and they drive the market lower. Now, it's obviously different than the S&P somewhat, but the concept is the same. And you just start to see red, basically, on Jigsaw, which is, the big thing about Jigsaw. You're seeing red. They pound it at 5.5. They hit it at 5. They stack up the offers. They're going to hit 4 halves right here. Boom, hit 4 halves. Stack up the offers. Boom, instantly hit 4s. Starting to tap into 3 halves, right? And so that's where you have stop orders being triggered off below the low of the day. And that's what the guys are going for who press it to those points. They're trying to press it through, right? So market trades on down, and the point there basically being, from a context perspective, as long as guys are banging into bids, and clearing them out, going back to what I had talked about earlier in the discussion, where I was overrunning. Let's say if you're the only guy on the offer and I'm the only guy on the bid, I mean, as long as I'm bidding prices up and running over you, there's no reason for somebody else to step in front of me. You'll try to step in front of me because you're going to want to try to cap the market and hold the market down in hopes that I give up eventually and the market pulls back in, so you don't have to take a huge loss. But it all depends on who else is there. And if no one else is there to help you, I'm just going to run you over. And that's what happens in locations like that. And that's what triggers orders to be run off, okay? So that kind of basically covers what I was saying. The only other thing is the luck factor. If you're talking about trading, and I'll always bring this up, and then we'll go to Q&A. I'm running a little bit longer than I anticipated. In spite of what anybody tells you, there is a luck factor in trading. It's not necessarily whether you make money long term, but it's more in the sense that on any given day, anything can happen. And so what you try to do when you develop a methodology is find something that seems to work more often than not. In other words, when you see them hammering bids, you don't step in front of that. You know what I mean? You go, if you're going to do anything, you try to go with it, at least as long as they're hammering bids. You need to be on the short side. That's not always going to work because some days they're going to hammer the bid and you're going to sell it, and you're going to be the guy who sells the bottom. I mean, it's going to happen. There's also other days where you may try to do it and the market may only move 2 ticks and stop. And there's nothing you can do about that because you can't move the market yourself. And then there are other days when the market completely disintegrates, like that chart I showed you, and you're going to get short up here at 56 or something, and the market's going to fall straight to 46, and you're going to bank huge. What day is that's going to be? You don't know ahead of time. So there's always a luck factor in terms of how much you'll make if you're right. Is it a good volatility today, et cetera, et cetera. And a totally different topic that we can't discuss today is, the way you ride that out is having the proper risk parameters in place, basically. And you just got to make sure you're not allowing yourself to get destroyed when you're on the wrong side, so that when you're on the right side, those winning trades make up for the small losses on the backside. All right, so let's move it on. Let's go to Q&A. Mike, do you want to pick the questions and read them out, or how do you want to do this, bud?
Yeah, so we got about 15 minutes or so for Q&A. There's quite a few questions right now, so let's see how many we can get through.
All right.
Excuse me.
A little bit long there, sorry, but
No problem. CH asking, how do you use or trade the Ultra Bond? Do you prefer it to the 30-year? What is essentially the difference between the two?
Okay. So the difference mainly, without going into like contract specs, you can look up the actual contract specs on the CBOT website. But I've recently been bringing up the Ultra Bond because not often, but sometimes it offers a little bit of a clue, at least from my perspective. It's light volume, as you can see, and it's been moving a little bit more from a readable standpoint in the 30-year. Yeah, like I still watch the 30-year, obviously, and I watch the 5 and the 10. I watch all of them. But yeah, the 30-year has been somewhat thick in terms of not moving like it used to move. It used to move a lot more, and the 10-year and the 5 have kind of overtaken that because people have been transferring into shorter-term products. So with the Ultra, I have it up because it's a little lighter volume, and guys who trade, I think a lot of guys who are trading longer term, they've become somewhat upset with the fact that the 30-year has become so thick, and so they're trying to fire off some trades in the Ultra where they can actually get paid at times, because there are times when the 30-year is only moving one tick, and the Ultra may pop 3 or 4, So that's kind of how I've been using that.
Okay. There's about 30 questions right now, so I'll try not to pick any that are too repetitive, but PK is asking for a new trader, a new guy that's starting out, which one is best, the 5, 10, or 30-year?
You have to watch them all. That's definitely something I talk about. If you're going to trade if you're going to, and everything that I'm talking about, let me just illustrate real quick. It applies to all markets. It does. But every market does have its own nuances. So obviously trading the S&P is not like trading treasuries from like the overall concepts and precepts are the same, but execution does have to be different. If you're going to trade treasuries, you need to watch all of them. You'll eventually. It looks overwhelming to new traders to watch the ladders, but that's why I pulled up those images earlier, showing those guys. That one guy who was looking at 13 different ladders on the screens. Once you become accustomed to it, it's not as difficult as it looks. And Peter even says the same thing. He said the first time he saw me looking at 3 or 4 depths of markets, he thought it was kind of wild, but then it only took him a few weeks to do it himself.
Andrew says he trades the NASDAQ, and he says it's thin and usually moves very fast, oftentimes 2, 3, or 4 ticks in the blink of an eye. He's having trouble reading the fast order flow and reacting quickly enough, and he would like to know any suggestions to improve his odds of getting the edge on NASDAQ.
I typically advise against thinner markets for that very reason. But if you are going to trade them, like the NASDAQ or the DAX or oil, I would say, something like that, what I've been finding, and I'm not a proponent of trading those, but what I've found, because I do watch them, and I have traded the DAX and the NASDAQ, you basically have to use stop orders. That would be my suggestion. Like you kind of have to anticipate where you think a run is going to take place, and you can't rely on yourself to click the mouse as it's happening. I mean, you have to have a stop limit order in place, or a stop market order. You got to be careful about them. If you put a market, though, you don't want it to be too far off. You need a limit somewhere. But yeah, so if you think they're going to run a price and that's going to set off orders, you should already have a stop market order working. That's going to get you filled so that hopefully you'll beat a program to the punch as it's going through that price. But yeah, it's pretty hard to get the edge in a thin market like that. Which is why I typically advise, when people are learning anyway, they go to thicker markets just to at least to learn and then move back into thin markets.
Okay. Harry wants to know about false or fake orders on the dome. I believe that he's talking about orders that pop up with a lot of size and then get immediately pulled, and possibly also the flip side, like icebergs.
Yeah, for sure. So the spoof orders, meaning the orders that pop up and disappear, again, you have to view those within the context of the situation, basically. Like, if it's an area, when they're breaking down like this and sellers are piling on board, those orders are probably all real. You know what I mean? And so you can be pretty sure those sell orders are most likely there. There'll be other times of the day when the action's different, where you can notice that maybe there'll be 4,000 on the offer, and then that 4,000 will drop away to 2,000 or 1,800. How you play that depends on a lot of different factors. Again, that kind of goes beyond the scope of this presentation, but it does matter. At times, you definitely want to pay attention to spoofs, and with regards to icebergs, you obviously want to pay attention to icebergs as well. It's the same thing, though. It's a lot about context. An iceberg order in the middle of a range during, at the noon hour probably doesn't mean much. An iceberg order, maybe coming after some news might have an effect. So it's all about viewing those orders within the context of the current price action.
Okay. Jeff is asking if you've looked into using a footprint chart, and why not use it as an order flow tool. So, footprint chart, some people call it a volume ladder chart, where you can basically have chart size of your whatever you want, one range, 1 minute, 10 minutes, whatever, and it prints bid-ask volume ladder.
Right. I do know what footprints are.
I'm sorry, I was explaining for everybody else.
Absolutely. No, I know, and it occurred to me, it's like, oh yeah, he's saying that because other people may not know what footprints are.
Yeah.
Footprints, for anybody who uses them or is thinking about using them, this is totally a personal preference on my part. Like I said, I am a TTX trader guy. I mean, that's where I grew up, I should say. So I am somewhat biased to strictly staring at bids, offers, and the inside prints. That's just me. So that's how I learned. I think it's very clean that way, so I don't get too sidetracked. However, I do know some guys that they like the footprints. They like to be able to look back, like you said, over maybe 2-minute footprints or 5-minute footprints, and it helps them establish points of heavy volume, or like point of control, some people would refer to it as, and they use that in conjunction with the market profile. So for me, it's more of a preference thing. I find that I react a lot faster just looking at the depth of the market. That's why I prefer Jigsaw. I think it's like the cleanest out there for that. But I don't, if you like footprints, you like them. No, I'm not adverse against them. Probably just a personal preference thing on my side.
Okay. Jeff's asking, how there's like time and sales filters where you can filter by size. He's asking if big money moves the market, why not filter the order size by a certain size, a big size, so that you can see when those block trades come off or whatnot, and when they hit the bid or ask.
Right. That's an excellent question. I'll tell you why I don't pay much attention to time and sales and big block orders. It's because often they disguise their orders, and oddly enough, if one order of 3,000 drops in the market at one time, like it's not worked at all. It's just somebody goes buy 3,000, boom, hit it. It's quite frequently the market just stops. It doesn't go one way or the other. It's a weird thing, but size does move it. But the thing to keep in mind is it's also a conglomeration of size. So it's not just one guy moving an order. I mean, I use that example obviously for when I was describing the initial me versus you, but it's a guy moving 1,000, 5 guys moving 200, 10 guys moving 100 or 50, and then another guy maybe moving 3,000. But they're all working orders around the current inside market. And even a guy who's trying to get net long, let's say he's trying to get net long 10,000 contracts, he's not just going to buy 10,000 contracts. So he's never going to tip his hand that way. You know what I mean? He's going to end up buying and selling back and forth within a range until he nets out. So it's really hard to figure out if it's just one guy or if it's multiple guys. So reconstructing, I mean, I think there are times when that can be helpful if the market's moving one way. But in general, I find that you get enough information just by viewing the inside prints and the total, so the total accumulation of inside prints, which also show up on your daily right there.
Okay. Sands is asking, if you let the snapshot of the current trades, basically all the values on your dome, do you let it accumulate over the entire session, or is there a situation in which you would reset it at a specific time just to view, maybe after news or something like that?
So for both of these, what I basically do is on the insides, I leave the inside up on Jigsaw, mainly because it shows me sometimes I might forget the exact price that some order went off. For example, let me just back this up real quick. So for example, right there, now we know this was at the bottom of the day, but like that 6,000 stays there. All right, so if the market were to get back there, I would remember, oh yeah, somebody bought 6,000 there. That's why I leave these up pretty much all day long. Other people like to clear them out. Again, that's personal preference. With the side profile, I reset that every night when the market closes. So whenever the market closes down, this goes to 0, resets on the Globex open. That's, again, I think you should have the overnight numbers up there, but some people don't like to kick it in until later in the day, but that's just me.
Okay. Mike asking, on the ES chart that you showed earlier, a screenshot earlier, there's a big V reversal. Is it possible that the big money traders that first drove the market down to the lows are the same traders that then turned around and bid it back up?
Absolutely. As a matter of fact, most likely this initial bump right here back up to 18, where are we at? So I have to get this initial bump back to 1856 right here was probably a major result of short covering, because you had guys that got short the whole way down, and at some point they throw in the towel. I mean, they don't throw in the towel. The guys throwing the towel are the guys who get caught long. But yeah, at some point, people who are short realize they've got to cover, and they begin working orders. And when they do, they end up helping to stop the market. And if they stop it well, if they realize they have the edge again, they'll turn around and go the other way. It's not that they're necessarily trying to take it all the way back to 66, but if there's enough size there and enough, it's not like, again, it's not just 3 or 4 guys. I mean, we're talking, with the S&P, you're talking about hundreds of people, but all those orders feed off of each other. So as those orders feed off of each other, you end up having the heavy money again start to drive it back up, and that's why, again, that's why you can't sit and trade. That's why you got to be reactionary. So if you're short 1850 and the market drops to 44 and you didn't cover all the way back to 1850, you probably shouldn't sit there hoping it goes back to 44, because you've lost the edge at that point.
Okay.
And the market's going to press against you and you're going to take a loss.
Robert asking, does the market tend to run from low volume area to low volume area?
Not actually. It's the opposite. Well, it depends. Again, context. So what typically happens is the opposite, though, in the way that, let's say you have this size over here, you have 80,000 to 80,000, and you have this range, and then eventually it moves out of the thickness into a thin area, and then it develops another thick area somewhere and kind of slows down. That S&P, what I was showing you, very, very simple explanation right here. So you had kind of a thicker area, 9,000, 8,000, and then you have a thinner area, and then you have a thicker area building up. And then that, when it went again, they took it out again, it was thin, 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 and then it thickened up. So that's normally what you have. You have these periods of run, cover, run, cover, run, cover, but, then guys come back into the markets. So that's another thing to remember. Like, a lot of people view it as I buy and then I sell and then I'm out. But scalpers, or not just scalpers, but HFT and pro traders, they may buy and cover and immediately say, man, I got out too soon, buy it again, they hit it again. And they cover and they're like, nope, still going, buy it again, hit it again. So yeah, you shouldn't be afraid to jump in and out if the market's still going in your direction.
Right. Okay, Reed has written a book, so I'm not going to read your question, Reed. It's going to take too long. But here in a few minutes, when we're at the end, John will give out his contact info, and you can email him your question, and he can spend some time answering. Option Trader's asking, what are your 3 most profitable setups using the ladder?
Well, that is something that I would also say write me about. Not like it. A lot of context goes into it.
Yep.
So there,
Yep.
that requires
Sure.
3 hours of explanation. But definitely,
Right.
Write me if you're interested.
Yeah.
Sorry.
No problem. Roland asking, how many trades do you execute on average in the bonds?
In the treasuries, I probably execute on average between maybe 5 and 15 on a. It depends on the day. There'll be some days it might be zipping around, and I might do 20 trades. There are other days where it might be really slow, and there's like 2 trades. It just doesn't even move. So,
Right.
It totally depends on the context of the day. But I would say don't. That's one thing that a lot of people do ask too, is like, how many trades should I be making? They shouldn't really focus. I don't think you should focus on the number of trades. You should focus on whether or not it's a good trade, or whether you think it's a good trade that falls into your plan. And don't be worried about whether you make 2 trades or 15 trades. The point is the bottom line. So however you get there.
Brian is asking what your data source is for these charts. And I think he's also asking brokerage. So I don't know if you're using 2 different feeds from your brokerage or what.
Yeah, I'm using I'm on Kinetic is what I use for my data feed. So I have Jigsaw running through NinjaTrader, and then I have the data feed running through Kinetic is what I use.
Okay.
I found it works for me as a setup. CQG also works very well for Ninja, and I'm not personally familiar with Rhythmic, but I've talked to people who say Rhythmic is fine too. So it just depends on how you're set up through your brokerage and what works for you.
Right. Okay, let's see. Trying to filter just a couple of these questions for things that we've already covered.
Sure.
DBH wants to know if you could use this method to manage trades and to tell you when to get out or to take profits, or do you look at the print to find out if it's I'm having a little bit of trouble with this question. I think that the gist of his question is whether or not you're looking at the DOM to decide where to take profits.
Yes. Well, for the most part, I would say whenever I get in, and again, this isn't just me, this is most guys, they have to do this because, especially if you're a guy moving size, I mean, you have to have some idea of where you probably want to exit. And that doesn't mean you won't get back in, like I said, but you don't, for example, if you're in a, say you're in a winning trade, let's go winning trade wise. If you're in a winning trade, you don't want to randomly just put out an order because you think, well, this is supposed to be a support or resistance level, and then watch the market blast through you by 5 ticks. That really sucks when that happens because you place an order and immediately you would have had 3 more ticks in the money. But you should have somewhat of an idea of where you think it's likely, and again, that goes back to context. On certain days, you might take a trade and you only anticipate that you're going to get maybe 3, 4, 5, 6 out of it if you're right because there's not a lot of volume. Other days, you might be right on the side, like with this, this ES trade, or not trade, but just ES movement. And you're short and you're on the right side and you have the edge and you're like, hey, you know what, let's just give it a run and see what happens. As long as they're selling it, I'm going to be in. And then eventually you look for signs that maybe this theme's run out and then you get out of the trade. But yeah, I use the depth of market primarily for distinguishing exits on the losing side too, as well, whenever I take losses.
Okay.
But I have somewhat of an idea of kind of where it probably should go if I'm right. Not that it will get all the way there, or not that it won't get past that, but I kind of have an idea ahead of time, and I think most people should have somewhat of an idea.
Right. Okay, I am skipping all the questions related to risk, even though I think that's a fantastic topic to discuss because it's going to take too long. So guys, you can email John directly. Otherwise, we'll have to see if we can do it at the webinar on risk. Jensen, sorry, hang on.
Mm-hmm.
All right. Jensen's asking, do you use the reconstructed tape feature on the treasuries, and do you see big orders and the prints on the latter?
Yeah, so that goes back to what I said earlier. I don't use the reconstructed tape on the treasuries because I've personally found that just watching the amount of size on the inside, whatever it may be, is enough to kind of follow the flow. And like I said, there's so much size, like there's so much more size in treasuries versus stock indices for the most part, that just because you see an order of 700 or 1,500 hit at once doesn't mean it's necessarily going to have a huge impact. So more critical to focus on total volume trading and then how it's trading within the current scenario.
Okay. Alex is asking if you look at or use cumulative delta. Not everybody knows what cumulative delta is, so basically it's a way to track over time, like either at the beginning of the session or some people run it for weeks, months, or whatever you want, the number of trades that are executing at the bid versus the number of trades executing at the ask.
That's a good point. That's actually what this is down here. I didn't even cover that at all, but Jigsaw has a feature called the strength meter, and they also have a tape that you can use for cumulative delta, but a quick way to figure it out is, for example, right here, you'll see 194.979 in red, and then you'll see 190, 167 in blue. So quick mathematics in your head, that tells you that this is the total amount that's hit into the bid. This is the total amount that's hit into the offer over the course of this day. So your delta would be almost 5,000 to the downside. Meaning 5,000 more contracts have hit the bid rather than have hit the offer. However, what you'll see is that the 5-year, is near the high. So I am paying attention to it, but usually only, again, within the context of how it's affecting the market right now. So if they're running new highs or something right there, then yeah, you'll probably want to start paying attention to if there are more contracts hitting the bid than the offer. But in the middle of the day, in a range, that doesn't usually tend to matter very much.
Okay. Eduardo asking some volume profile questions, so feel free to say if it's not applicable to this webinar. He wants to know if you watch key levels like the low volume node or high volume node from previous days, like in a composite volume profile, or if you're only using the profile for the current session on the dome.
I tend to only use the one on the dome, but I'm aware of points from the previous days. So I don't actually look at market profile charts, but like, for example, going back here just so I can make this point. For example, this section between 11.5 and 13, where it's 80,000, 80,000, 80,000 all the way in those four prices. The next day, I would, I have a note, or I remember it just because I watched this all day, but you can just make a note, and I'll remember, oh yeah, 11.5 through 13 was a heavy volume period yesterday. So if it gets to that point again today, I'm liable to see it just chop around again in that area. That's kind of how I use the back. I definitely don't go back market profile like a week or two prior. It's just too much can change in one day, let alone 1 week.
Sure. All right. We've got one question left at this point. I think I'm going to stop it at this last question, and then we can go on to your contact info and such. And it just scrolled off my screen, so let me go back up. Okay. Jade is asking, he says, hey, I was considering working or trying to find a prop firm to work for instead of trading his own capital. Do you have any comments or recommendations for him, and would you go back and trade at a prop firm again yourself?
So for me personally, I would not, because it doesn't suit my particular life. And from that standpoint, it just means, because I can back myself, and usually you have to live in a big city. Like, it's rare that you can work for a firm, even if you're good. You have to work for a firm in Chicago or New York or the UK, London, somewhere like that. and I live in Florida where it's very warm. So I won't go back to Chicago. But for a new guy or someone who's trying, I wholeheartedly recommend it. If you can land the job, the experience will be invaluable. Now, again, assuming a big caveat here, assuming we are talking about a major firm in a big city or just a major firm, because a lot of, quote, prop firms are kind of just brokerages, and they might fund people, but you know what you need from a prop firm is capital and very low transaction costs, meaning hopefully your prop firm will have a seat on the exchange.
Yeah,
So
you're talking
whenever
about
you're trading,
like the difference between a prop firm and a trading arcade.
yes, exactly, 100%. So thanks. I haven't heard arcade in a while, but you're absolutely right. So a real prop firm, I hate to say real, but you know, one that has a seat. Like when I was trading for a firm, I was paying 50 cents a round turn. You know, so a retail trader usually can't pay more than, or was going to be paying $2-3 a round turn, $4, whatever the case may be. So if the firm has great rates, they have seats, they'll give you some money, they'll put you in front of a desk, and hopefully they'll give you a salary or a draw, because it's really hard to sit there for most people and pay the rent. Like it's hard to. I discussed this and some other stuff, so they can check it out on YouTube for free. But it's hard to sit there and like work as a bartender or something at night and then go in and trade in the morning. So I don't usually recommend that, but I recommend the experience. It can't hurt you at all. You'll get to see something. You'll see it from the inside, and if it turns out well for you, you'll be in an ideal position to make money because you'll have access to a lot of capital and really low rates, and that's what you need to move on.
Okay, let's call it there. John, do you have a slide or anything with your email or website, or do you wanted to say it?
Man, I don't. But if you want to go, it's just nobsdaytrading.com.
Okay.
And you can hit me up through my contact page, or you can write me at john@nobsdaytrading.com.
Okay.
And yeah, I'll be happy to answer any questions anybody sends. And thanks a lot, Mike. I really appreciate it. I know you said your voice is out and you're not feeling well, so thanks for managing the questions there.
Yeah. Hopefully you guys could hear me okay. So for anybody that did not get their questions answered, and I know there were several, then please email John. So john@nobsdaytrading.com. For anybody else that has questions on what he does, you can hit up his website. And for anybody that wants to check out Jigsaw, who has made this webinar possible, you can go to jigsawtrading.com. All right, guys, I'll post the recording for this sometime later today, and I'll see everybody later. Thanks, John.
All right. Thanks, Mike. Appreciate it.